The silence you are hearing in the markets right now is not peace. It is the suffocating calm before a potential volatility storm that could redefine the remainder of this trading year. We are sitting on a powder keg of macroeconomic data, and the fuse is lit. The bond market, specifically the 10-year Treasury yield, has quietly crept back up to the critical 4.2% level, a technical danger zone that has historically acted as a ceiling for equity valuations. While the retail crowd is distracted by headlines about quantum computing and AI chips, the smart money is hedging. We are less than 24 hours away from a CPI print and days away from a Federal Reserve decision that will determine whether this year-end rally has legs or if we are about to face a brutal reality check. This is not the time for complacency. This is the time for precision execution. Let's dissect the macro landscape, because the signal-to-noise ratio is currently dangerously low. The narrative on the street is that the Fed is locked in for a rate cut, with probabilities hovering near 90%. However, the market is mispricing the nature of this cut. We are looking at a classic Hawkish Cut scenario. Chairman Powell may give you the 25 basis points you want, but the accompanying dot plot and rhetoric could signal a prolonged pause in 2025. Why? Because the labor market is softening but not breaking, and inflation remains sticky above the 2% target. If the Fed signals that the easing cycle is slower than the market's aggressive pricing of rate cuts, the repricing in risk assets will be violent. Watch the 10-year yield like a hawk. If we break above 4.3% on a hot CPI print or a hawkish Fed, the valuation premium on the Nasdaq 100 will evaporate. We are seeing a divergence where yields are rising while stocks are near highs, a divergence that historically resolves with stocks catching down, not yields catching up. Now, let's pivot to the specific battlegrounds defining today's tape, starting with the most significant casualty of the morning, Oracle. The stock is hemorrhaging, down over 7% in pre-market action, and for good reason. The headline numbers tell a story of a company at war with itself. Yes, the AI cloud infrastructure revenue soared by over 50%, confirming that Oracle is indeed a legitimate player in the AI capex cycle, stealing market share from AWS and Azure. However, the legacy business is an anchor dragging the ship down. Revenue missed expectations, coming in at $14.1 billion versus the $14.2 billion anticipated. In this market, priced for perfection, a revenue miss is a capital offense. The bull case here is that the backlog, the remaining performance obligations, RPO, is exploding, up 50% to nearly $98 billion. This suggests future growth is locked in. But the bear case is immediate. Margins are under pressure as they spend aggressively to build out data centers. We are seeing a classic capex indigestion phase. If you are a long-term bull, you wait for the dust to settle around the $165 to $170 level. Do not catch this falling knife until we see a stabilization in the daily volume profile. On the complete opposite side of the spectrum, we have Alphabet, forcing the market to respect its engineering dominance. Google shares are ripping higher, up over 5%, driven by the unveiling of Willow, their new quantum computing chip. This is a massive narrative shift. For the past year, the street has treated Google as a show-me story, fearing that OpenAI and Perplexity were eating its lunch. Today, Google reminded everyone that they possess deep tech optionality that no startup can match. Willow's claim of solving a calculation in 5 minutes that would take a supercomputer 10 septillion years is the kind of hyperbole that reignites the Magnificent Seven innovation premium. The technical breakout here is significant, as it pushes the stock back towards its all-time highs, challenging the $185 resistance. However, a word of caution. Quantum computing is a long-duration play with zero immediate revenue impact. This is a sentiment rally, not an earnings rally. Chase it only if you are playing momentum. Otherwise, fade the move as it hits overhead resistance, especially if the broader market sells off on CPI news. Finally, we must address the elephant in the room, Nvidia. The stock is frustratingly flat to slightly down despite what should be a massive geopolitical win. Reports confirm that the administration is clearing the way for the H200 chips to be sold to China, albeit with tariffs. On paper, this unlocks billions in pent-up demand from Alibaba, Tencent, and ByteDance. So why isn't the stock soaring? Because the market is forward-looking and skeptical. The fear is that China's own domestic chip production is ramping up faster than expected, and these tariffs could squeeze margins. Furthermore, Nvidia is currently stuck in a consolidation box between $130 and $150 split-adjusted context. It is coiled. The technicals showed declining volume on this pullback, which is constructive, but it lacks a catalyst to break the $150 ceiling until the broader semiconductor capital expenditure outlook for 2025 is clarified. Nvidia right now is a proxy for the entire market. Fantastic fundamentals, but priced for perfection that leaves no room for error. If the 10-year yield spikes, Nvidia will be the first ATM that fund managers visit to raise cash. To summarize the playbook for today, the risk-reward is skewed to the downside until we clear the macro hurdles of CPI and the FOMC. We are seeing defensive rotation into software and erratic moves in hardware. Do not get seduced by the Google headline into ignoring the Oracle warning. The Oracle miss tells us that enterprise spending is lumpy, not infinite. My actionable advice is to keep cash heavy. If the S&P 500 fails to hold the 6,000 psychological level or equivalent future-adjusted level, we could see a rapid flush. Watch the 10-year yield at 2 p.m. That is your true north. If yields drop, buy the dip in high beta tech. If yields rip, protect your capital and live to fight another day.